Is your current mortgage rate holding you hostage? Let me show you 3 ways to lower your rate and take back control of your finances. A recent article in the newspaper quoted a homeowner who recently moved as saying, "We had a 3% mortgage rate before, now it's 6.5%. Rates have really gone nuts." Ironically, the homeowner was correct, but for the wrong reason. The unprecedented downward move in mortgage rates at the beginning of the pandemic was a direct result of governments across the globe flooding the credit markets to stave off a recession, or even worse, a global depression. In the history of mortgage markets, not until July 2020 did 30-year rates fall below 3%. So now we find ourselves in a more normal market where the Federal Reserve has raised the federal funds rate in order to fight inflationary pressures, going from about 0.1% just about a year and a half ago to 5.3 now. Many borrowing rates reflect the federal funds rate, so we've seen a big increase in long-term mortgage rates. And the result is that a lot of homeowners who either borrowed to purchase or refinanced their existing mortgages just a few years ago are now thinking about moving, and they feel somewhat trapped, apprehensive to go from paying 3% to 6.8%. What's a homeowner who wants to move do? There are some smart moves that you can make that can make a substantial impact on the rate you pay. 1. Explore your rate options with a mortgage broker versus a mortgage banker. What's the difference? It's huge. Mortgage bankers work for a bank and they offer the loan products and mortgage rates of that one institution. Whereas a mortgage broker shops your loan to multiple lenders throughout the country who then bid for your loan business. You'll be offered a wider selection of loan products and receive the terms and rates that are the most favorable to you. On top of that, a mortgage broker can work with you to potentially raise your credit scores. A higher credit score can result in a mortgage rate a quarter point lower than one with a lower credit score. 2. Consider paying points on your new mortgage in order to buy down the interest rate. 1 point equals 1% of your new mortgage. Where are you going to get that cash? From the equity you've acquired in the past 2.5 years. You could potentially drop your rate by 1/4 or even 0.5%. 3. Reduce the mortgage term or consider an adjustable rate mortgage. ARMs typically have rates lower than the 30-year fixed rate, and you can obtain loans that won't adjust for 3 to 5 years. Remember, rates change daily, and the Federal Reserve has aggressively raised rates in the past year or so. When does that tightening level off? When does it ease? And does it happen in the next 3 to 5 years? To recap, don't let a low mortgage rate hold you hostage and limit you in where you want to live, work, and play. If you like my message, subscribe. If you're thinking about making a move, call, text, or email me. Thanks for watching.